Welcome to the special report. Recent discussions surrounding former U.S. President Donald Trump's potential return to imposing tariffs have stirred significant reactions in financial markets. Market analysts are pointing out that these reactions are not just typical fluctuations, they are sending unusual and deeply concerning signals that could even threaten the core status of the U.S. dollar as the world's reserve currency. Traditionally, during times of global economic or geopolitical uncertainty, investors flock to what are considered safe haven assets like U.S. Treasury bonds. This demand typically pushes bond prices up, which lowers yields and is usually accompanied by a strengthening U.S. dollar. However, market behavior in recent weeks has been distinctly different. Alongside stock market sell-offs, we've observed a simultaneous selling pressure on both U.S. bonds and the U.S. dollar. This specific combination, rising bond yields alongside a falling dollar, is highly unusual for a major developed economy. It suggests that investors are not seeking safety, but are actively retreating from U.S. assets. This dynamic is more typically seen in emerging markets facing capital flight risks, or during moments of specific policy-induced crisis, like the UK experienced after the mini-budget under Liz Truss. It strongly indicates that markets may be beginning to demand an additional risk premium to hold U.S. assets. Adding to these concerns, beyond the uncertainty of trade policy, is the U.S. as domestic official situation. Congress is reportedly preparing for significant fiscal easing, potentially including the renewal and expansion of tax cuts from the previous Trump administration. Such large minus-scale government spending plans, particularly during a period of relatively strong economic activity, are putting further pressure on the bond market and the dollar. What's particularly striking are signals from within the former Trump administration itself. Some senior figures have openly expressed skepticism about the benefits of a strong dollar acting as the reserve currency, even describing it as a tax on manufacturing workers. Ideas floated, such as asking foreigners to pay for services the U.S. provides, including the reserve currency, represent a significant departure from the U.S. long-held policy of welcoming a strong dollar as a global safe harbor. Such public statements from high-level officials, even if exploratory, erode global investor trust in the dollar's presumed stability and reliability. Should this trend persist and worsen, a potential nightmare scenario could unfold. Foreign investors could accelerate their selling of the trillions of dollars in U.S. Treasury bonds they hold. This would further drive up bond yields, dramatically increasing the U.S. government's borrowing costs. Given the U.S. substantial national debt, currently around 100% of its GDP, just the rise in interest payments would place immense pressure on the federal budget. In such a situation, Congress would face immense pressure to rapidly implement fiscal austerity measures to stabilize the markets. However, in the U.S.'s current highly polarized political environment, achieving swift consensus on spending cuts, particularly to programs like Social Security, appears extremely challenging. Should a potential president veto necessary measures, political gridlock could severely hamper effective crisis response. At the same time, the Federal Reserve, or the Fed, while typically acting to stabilize markets in a crisis, could face constraints. Current inflationary pressures limit its ability to deploy large scale quantitative easing, as it did in 2008. Furthermore, the possibility of political pressure and the upcoming appointment of a new Fed chair could raise concerns about the Fed's independence and willingness to act, particularly if its actions might be perceived as directly financing government deficit. A lack of coordinated and effective political and monetary policy response could escalate market instability. If the dollar's reserve status were genuinely threatened, the global financial system would face significant disruption. Experts note there is currently no single alternative currency that can immediately provide the same combination of safety, liquidity, and economic scale as the U.S. dollar. The Chinese yuan remains restricted by capital controls. The euro is a unified capital market. Other currencies are too small. The absence of a clear focal point for reserve assets would mean the global financial system becomes more fragmented, less stable, and more prone to panic-driven capital movements. Ultimately, even a future U.S. policy manages to stabilize markets and rebuild confidence, some damage may already be done. The public questioning of the dollar's status by high-level officials from the previous administration has introduced a level of uncertainty into investors' minds. As a result, U.S. assets, particularly bonds in the dollar, may carry a small risk premium going forward, representing a form of permanent cost incurred. While a full-blown crisis is not yet upon us, these early market signals are a stark warning, exposing potential vulnerabilities in both the U.S. financial and political systems when faced with external pressures.